Hi there, Livewire viewers. It's James Marley here, co-founder of Livewire Markets. And I'm joined today on Views from the Top by Dr Philipp Hofflin, who is a portfolio manager and analyst at Lazard Asset Management. Now, many of you will be familiar with Philipp. He's presented on Livewire over many years, but I want to bring your attention to a prediction that he made at Livewire Live in 2019. He called that after many attempts to stimulate the economy, that the Chinese economy would start to falter and the government would struggle to bring it back to life. That's what we're seeing playing out right now. Philipp, how significant is the China story that's playing out for Australian investors?
The prediction that we made back then was really based around the fact that the Chinese economy was very property dependent. There was one statistic that I haven't verified, but it was claimed that half the world's property sales were in China. Had a very, very dominant part. There were clear signs of overinvestment and oversupply of residential property in particular. And lastly, we looked in the past at Asian tigers. We're talking Korea, Taiwan, Japan, and so forth, over their most tigerish decades, and they all had regular capex recessions. China didn't. Because again and again, the Chinese government kicked the can down the road, as they did in 2008-9 or in 2015, used the banks to lend a lot of money and avoided the issue, but at the cost of increasing leverage in the economy. And eventually, there's a risk that this comes to an end. So that was the basis of our concerns then. To answer your question about is it relevant, it is very relevant, right? So China makes about a third of the world's manufactured goods, takes a third of our exports, but more importantly, it's very often about half the demand in various types of commodities. So it's not just the case that they take a third of our exports, but they determine the price of almost 100% of our exports through their enormous role in particularly on the mineral side. So if you think of the Australian business model, if you will, James, we sell minerals and fossil fuels and we buy goods. Every car on the road out there, every motorbike, truck or bus is imported. Every laptop, PC, iPad, phone, or if you think of capex, every wind turbine, every photovoltaic array, all this stuff is imported. So what matters to Australia is what is the ratio of the prices between what we sell and what we buy? And that's of course called the terms of trade. And for the last 20 years, the terms of trades have been about 40% higher than the 150-year average. So every time we sell one unit, we got 1.4 times what we normally get in terms of iPads back. I think it's fair to say a reasonable part of that has been China. So if China really has a significant downturn, that is a problem for us. It will crimp our lifestyle. It will make us less wealthy because the exchange terms of the rest of the world have deteriorated. So China matters because China is important for commodity prices.
Mm-hmm. And what are some of the flow-on impacts that you've identified?
Some of the flow-on impacts would presumably be that we go from an external surplus back into deficit, probably put pressure on the dollar, may even limit our ability to run much lower rates than the Northern Hemisphere. But all of that I should emphasize, James, it's all an if, right? In the sense that the Chinese government has much more control over its economy than most because it controls the banking system. And usually when things go wrong, the banking system acts pro-cyclically. They stop lending, they get worried. In China, that is not the case. The policy banks and the whole banking system follows the directive of the government. And then a large part of the economy, all the state-owned enterprises, are also under direct government control. If the Chinese government wants to go out and spend a lot of money again, at the expense of making the debt situation even worse, they can. I think at the moment, the real question is the question of the willingness. And it looks a little bit as if President Xi is determined to do the right thing and take the pain and make the adjustment. The risk is it gets out of control.
So if China takes the pain, how does that impact your portfolio?
Look, one of the areas that we have been concerned about is obviously, the concerns in China focus very much on residential. Residential means cement and steel. Steel means iron ore. So, we think the iron ore price is still above the marginal cost of production. So we are underweight iron ore, mostly through Fortescue and BHP. And we do think that the long-run iron ore price is going to be lower. Now, having said that, James, we're scratching our heads as to why it's still at $115 a tonne, given all this news, but we think the risks are skewed to the downside.
Mm-hmm. Are there some potential positives to a China slowdown story?
Look, it's an ill wind that blows nobody any good. So the biggest potential for that is probably that if it leads to a lower Australian dollar, that is very good if you're an investor in a company that is offshore based. Think of stocks like QB, Amcor, CSL, just through translation. It's also the case that companies that export, but not in perhaps minerals, they're going to be much more competitive. This goes directly to the margin. And even, let's say, our energy exporters, China's much less dominant in energy than they are on the mineral side, in particular in iron ore, obviously, where they're over 50% of the world. So it may actually be the case that some of these sectors do quite well because, yep, the oil price is lower than it would otherwise have been, but with the Australian dollar down 10%, you're fine.
We're going to change tact a little bit. A few years back, we were talking about if and when value investing was going to make a return after a sustained period of, poor years, particularly relative to growth investing. We were asking, would the uptick be fleeting? It's been sustained in the case of the funds that Lazard manages. What's changed in the environment that's enabled you to continue to find opportunities?
I want to answer the question, James, by introducing two charts, because I think it's very important to find out where we've been in order to explain what happened, let's say, in financial 23. The first chart just shows the forward multiples for the top and bottom quintiles across the ASX 200. So you take the 20% of stocks at the top, with the really high forward multiples, the ones at the bottom, and you chart those over time. And you can see there, on the left there of the chart, that back in March 2000, famously, the top end of the market went up an awful lot, ended up trading on 44 times forward. But that in 2021, we got to 56 times forward. And you can see there on on this data that for those top high multiple stocks, their multiples almost tripled from 2016 to 21. Huge capital gains, great for growth investors. But you can also see that this started to reverse in 22. The issue is the multiple at that top end remains quite high, as you can see on our chart, 37 times. Now, to predict what's going to happen in future relatively, you need to take the ratio of the two, right? If all ratios go up 20%, it tells you nothing about the relative performance. So we take the ratio, we add in a few other series, very similar, but ASX 100, take resources out because they stored things, that sort of thing. And we come to the second chart, which is our composite sort of dispersion indicator. If the number's high, as it was, you can see on the chart there, and we've sort of highlighted that in March 2000, there was a two-tiered market. There were the glamorous winners, and everybody else was bad. When the number's low, then the market's pricing fairly sedately and evenly. And again, you can see that the excesses this time around were a bit higher than even back then. You can see that big mean reversion in the first half of 22 gave us the best year in 30. But you can also see that for financial 23, that line just went sideways since then. Remains very high, in fact, similar to prior peaks, but it went sideways for 23. So it was a market that really neither favoured or helped value or growth in any way. And to move fast, that's the great environment. We like that. It's a little bit like, when you look at that chart between 2010 and 17, they're great years for us because we can add that extra little bit of value over time that really defines our process. Those big cycles, they are painful when the bubble goes up. Yeah. They're wonderful when it mean reverts, but really we prefer more steadier environments, and that was the case in 23. Made very good money out of some of the energy positions we've spoken about in the past. Whitehaven, Woodside did very well out of the insurers, stocks like QB and Suncorp, and some little stocks like a Smart Group, AP Eagers, and so forth also helped.
Yep. You mentioned mean reversion there. In late 2022, you explained a view that you thought the mean reversion that had already started would take 2 to 3 years to play out. Is that still your view?
I think it still is. I think that's the based on history, that's probably what we should expect, James, in the sense that I just mentioned these sort of things take years to develop. They take years to deflate on the other side. That's how it happened back in the early 2000s. I mean, having managed through that, I think the best analogy is with middle of 2001. If I take you back to that time, the speculative stocks had already fallen massively. They were gone. The Nasdaq had just rallied 30%, so people were saying, okay, the adjustment's over, it's all done and so forth. But that was only the start of the mean reversion that finally took all the way to the middle of 2003, of course. And because what remained was that there were, back then and also today, lots of perfectly reasonable and good stocks that just remained on really high multiples. And back in that cycle, of course, the glamour stocks were Telstra and News Corporation, can you believe it? Which is a great indictment of the market's ability to forecast future growth stories.
Yeah.
And it took those stocks literally 4 years until the narrative faded and they traded again at sensible, normal multiples and prices. And I think that's the same today. That's why on the first chart I showed, the top quintile is still at 37 times. That's still too high, right? For those top stocks, yep, 23, 24 times is fine, but not 37. So I think that's where we are now. And from a return perspective, those large stocks matter much more than the little speculative stocks. You know, back 20 years ago, you know, Sausage Software and Solution 6, and this time around your Cecils or Appens or whatever, they don't really matter very much for the index, and they're gone anyway. The adjustment is probably going to be in the larger cap stocks that just remain expensive. Mm-hmm. But I want to just divert a little bit here, James, because there's an elephant in the room, right? And the elephant in the room, obviously, we've had a lot of interest rate rises. And what's going to happen to this cycle? What's going to happen to the economy and so forth? Because clearly, the uncertainties are much greater than usual, simply because we have had significant rate rises that were forced on central banks. These are not voluntary. So there's some risks out there. And I just thought I'd just run through how we think about it and how we think you shouldn't think about it without really coming down and to any firm conclusions. But I've been seeing a couple of stories lately that sort of say, look, is it great that Australia and the US have avoided recession? And I think that is incredibly premature because, you know, Milton Friedman told us all about long and variable lags. So I just want to just tell you about 2 prior recessions that are really relevant. Let me start with the last Australian recession, right? RBA tightened all the way to mid-1989. But 1 year later, in the middle of 90, there was still a lot of debate about, have they done enough? Are we going to have a downturn? Yes, no, yes. The recession happened in financial 91, right? Very long lag. A more recent example that perhaps some of the viewers will remember much better is, you know, pre-GFC in the US, right? Greenspan cut rates to 1% after the NASDAQ fall, remained at 1% to the middle of 04, so 2004. They raised rates from 1% to 5.25%, so similar but a bit less than this time round, to middle 06. US economy was obviously not in recession in middle 06. In fact, almost by definition, the central bank is still tightening. The economy is too strong, not too weak. Middle of 06. By middle of 07, everything was fine. The market had gone up, the unemployment rate had fallen further, and everything, and you could have then said, oh, well, nothing's happened, it's all fine.
Soft landing.
And you know what happened, right? All hell broke loose in 2008. And that just gets me to a second point I want to make really emphatically, which is you just can't tell. And I want to give you 3 examples of our inability to tell. One is that you mentioned 2008. Well, in 2008, I remember in May 2008 sitting there reading learned debates in the American press about, is there going to be a slowdown or not? And this was in May 08. Now, the NBER now dates the start of the recession to the start of 08, right? But people are still debating it 5 months in. And let me give you 2 further points. One is the RBA tightened in March 2008. A quarter into the US recession having started. They couldn't see it either. And even more dramatic, the ECB, with thousands of economists on staff, close communications with their North Atlantic counterparts, they tightened in July 08. Now this was 7 months into the retrospectively dated recession, and it was 2 months before, you know, Lehman's went bust and it all unraveled horribly. So the only conclusion we can draw from that, and it's sobering and humbling, is we have no idea, James. None. We could be in deep recession by the 4th quarter. It could happen in early 25 when the debris from the tightening floats to the surface. You don't know. We don't know what's going to happen. So in our portfolios, we like to just say, look, I think there is going to be some damage. That's what history would suggest. But we have no idea when and how. The good news, I think, in the Australian market at the moment is there is no insurance premium you pay, or very little, to stay out of discretionary retailers, highly geared stocks, or credit risk. Mm-hmm. So at the moment, very happy to pay that insurance premium because it's very little. Stay away from those things. The risk may or may not eventuate, but we're happy to be away from that.
Yep. Avoiding those sectors.
Yeah, because now it will become more difficult, James. I think if we get a downturn, these sectors will get murdered. And then eventually there comes the point where the value guy says, right, this is now getting compelling. And then you have to make the difficult decision, okay, when do you get in? When is a price fall enough? But that's a difficult decision for the future at the moment. It may or may not happen. At the moment, I think it's relatively easy to avoid those risks, so we're doing that.
Mm-hmm. Well, let's talk a bit more about the portfolio. Your colleague Warren Robertson, I was doing some back reading, he described the approach that you adopt as concentration and conservatism. They're not often two words that I would by default link together. Is that still the playbook?
Look, that's certainly the playbook for our select fund and our defensive fund. And I think what my esteemed colleague is referring to here is simply the idea that we look for big discounts. There are not many of them. And of course, you don't get them all right, but you do look for big discounts. So you end up with a fairly concentrated portfolio, but hopefully one that has big embedded discounts in it and is therefore defensive in that sense. So I think the old story is a few eggs in your basket, but watch them very carefully. I think it's appropriate at that point when we talk about conservatism to just mention the fact that active value funds around Australia, ourselves and some of our peers that have been doing this for a long time, they're low beta funds, right? So and
can you just explain low beta?
Low beta just means that when the market goes up, they tend to go up a bit less, but when the market goes down, they fall by less. So systematically low beta. So they're defensive in that sense. And also when valuation is a problem, and certainly in the US that is an issue, and to some degree in Australia, value does very well when things go down. Let's talk about some examples rather than statistics. 1987 crash, well, fantastic for value. 2001, 2003 bear market in Australia, great for value. Second half of 2008, when in the big panic, our best 6 months ever. 2022, when the market fell, yes, value did very well. So value is defensive because there's sort of a caricature sometimes out there that our value is just a bunch of banks and miners. It's all cyclical stuff and so forth. That's not how it actually works. It's a caricature. My own experience is that in the last 20-something years that we've been managing funds, we've been underweight banks on average, been underweight miners on average, and we are today. Now, we have been very overweight at times because the cycle moves, but that's not where we are on average. So important lesson there, I think, is when it comes to valuation concerns in particular, value is very defensive.
Mm-hmm. Mm-hmm. Can we bring to life that idea of concentration and conservatism with a portfolio holding? Something that represents that?
One stock I think is worth talking about is our holding in QBE. It's one of our biggest active positions. I don't think we've spoken about it before. So it's a stock that, as you know, it's a global insurance company. It also does reinsurance, so it's balanced on inward and outward re. It's in Asia Pac, it's in Europe, and it's big in the US. The US is the less good asset. The other two have been much better. Stock has already doubled from the COVID era, but it had a very long and difficult run before that, because global interest rates were very, very low. There was a lot of excess capital, and what an insurer brings to the party is capital. So capital was free, so a lot of competition, premium rates globally were low. In 2019, premium rates started to pick up because insurance companies just weren't making money. Right? They realized they're underpricing risk. And that has continued on, longer than I would have thought. And we're still recording, double-digit premium rate increases around the world. This is great because this top line, you're getting paid more for the same risk. It's been above claims inflation for years. The second thing that we also noted back then was that rates were incredibly low, but that probably wasn't going to last forever. We always like to have some mean reversion and normalization in our numbers. And for QBE, the calculus is really simple. They have what Warren Buffett calls the free float, that comes from the fact that people pay their premium today, their claim is in 1, 2, 3 years' time. And in between, you hold all that money. And that free float for QBE is about 3 times the size of the equity. At the half-year result, they said the current run yield on the portfolio was 4.9%. Call it 5 to round it up, make it easy. When you hold 3 times your equity at 5%, you've made 15%. Tax it, and you're at a double-digit return on equity without having made any insurance profit whatsoever. So high yields have transformed these businesses. Now, rates may not stay that high forever, right? Because we may have a downturn, in which case we do get rate cuts. If we don't, rates stay high. So it's one of those two choices. But they're probably not going back to zero either. So there is, compared to the difficult years, much better support both on yields and I would argue on premium rates. Stock is on 8 something times 2024 earnings. There's a heavy skew to the second half because they took some hits in the first half on cats. But they've said, no, our guidance for the full year is intact. So let's see what happens. I think if they do deliver on the second half, it will have been a really impressive second half, and the market will say, okay, now that's the go-forward rate. So I think, like every other stock, there are risks. It's an insurance company, so we're going to hurricane season, James. So things could happen, winds could blow, but the odds there, in terms of skew, given the multiple, I think is still very much in our favour.
Okay, great. Well, that was a great thesis on QBE. Thank you for talking us through the details. To all you viewers out there, I know you would have enjoyed hearing from Philip again. It's been too long. We always love having you on. Hope you enjoyed the video. Remember to check in on our YouTube channel. We're adding fresh content every week.